Coach Steve here. A lot of my students ask about doing weekly iron condors because they feel from what they've heard that they can make money more often. And while this is possible, it may not be practical to do. But what we're going to do is we're going to do a test and we're going to compare a couple of iron condors. We'll compare the weekly iron condor 2 weeks out, and we'll compare it with one that's just over a month out, and we'll look at what the differences are on the risk graph, and we'll see why maybe one or the other might be more suitable for you. We're going to start by building a weekly trade or December 23rd options. For this test, today's date is December 10th. So I'm going to start by building Delta 30 options. This will be low probability iron condor. So the Delta 30 option for December 23rd would be the 228.50 on the call side. So I'm going to sell this and I'm going to make it $1 wide, and that's a 20-cent credit. Then I come over here to the put side, and Delta 30, just under Delta 30 is the 223.50, so I'm going to sell that. Okay, $1 wide. So now we have a 43 cents credit, and let's take a look at our risk graph. Okay. And I have my date set for expiration here, 12/23. The way you do that, you just click on the date, the calendar, and set it to the 23rd. That will give you the 1 standard deviation move shading here, which will give you an idea of where a 68% chance is that it'll close at expiration inside that area. So one other thing I want to do right now is I just want to check the probability of my trade, and I'm going to come over here and I'm going to set the slices, the price slices. Right now this one's set to current market, but what I'm going to do is I'm going to set them both. I'm going to set up 2 of them, and I'm going to set them to my break evens, but my expiration break evens. All right, so this is giving me the areas where my break even is for expiration on this trade. Now I'm just going to leave those out there right now, but take notice that it has, this trade right from the start has a 47.79% chance of finishing inside the break-evens, 29.77 to be outside on this side, and 22.44 to be outside the break-even on the downside. And when you're using the price slices to do this, you have to make sure that your date is set to the time, to the date that you want the probability of. If I was to change this date, you would see that the probability percentages are changing as well. So make sure you set this date to the expiration you're looking for, and then bring your price slices over to your break evens, and then you'll get an accurate number for what your probability percentage is of it finishing inside or outside that zone. All right, so right now we have our 2-week iron condor built with Delta 30 options. Our break evens are between 223.07 and 228.92. So what I'm going to do next is I'm going to come over to another Thinkorswim, and this time I'm going to build a iron condor 30 delta, but I'm not going to use December 23rd. I'm going to use January 20th. So this will be 41 days to expiration instead of the 13 days to expiration. All right, but I'm still doing Delta 30, so this is going to give me a little bit wider iron condor, but still Delta 30 options. So Delta 30 for January 20th, we're looking at the 230 strike. And once again, I'm going to sell these $1 wide, and I get 26 cents credit here. And on the put side, it looks like the, 28 delta here for the 221. All right, sell $1 wide. So I have a 47-cent credit here. And let's take a look at the risk profile. And let me set my slices the same way. Break evens, expiration. And let me change this date so that we have the right information here, the 20th. Okay, so what we have is I have it set up where my expiration, it's showing me the 1 standard deviation move shading for January 20th expiration. All right. My break evens are 230.47 on the upside and 220.53 on the downside. I have a 46% chance on this trade for it to finish inside my zone. So it's almost the same as the other one. The other one was 47.79. So what we're going to do now is we're going to actually look at these trades side by side so we can compare them a bit and just see right when we put on the trade what's different, what looks good to us, what looks a little bit, what would be an area that I might be concerned about. So as I look at the trade, you can see that the one on the right, the shorter duration one, December 23rd expiration, is definitely narrower. So it gives you less range, but you're also only giving it 2 weeks. It only needs 2 weeks to stay in that range. Where the January 20th one, we definitely have it a little bit wider. Still, one standard deviation move could easily pull it outside this range. So when you're putting on these low probability iron condors, you have to expect that at some point your trade is going to be under some type of pressure where you're going to have to decide how you want to handle that based on your plan. Now maybe you will take parts of the trade off if one side gets attacked, or maybe you'll roll up the side that's not being attacked. My preference is to give it some time, and if it's in the first for the January option one, for if it's in the first couple weeks of the trade and it goes outside the zone, I'm okay with it. And only when we get about half the duration is expired, then I want to see if I can, if I'm outside the zone, I want to see if I can make the trade any better in case it stays outside my zone so that I don't get a full loss on the trade. So I might do that by, let's say I came to the upside on this trade and I was here at a $100 loss, and time started passing by, and I'm concerned that it's going to wind up being a $265 loss at expiration. So I'll give it some time, especially if there's a major area of resistance above the market where I feel it would bounce off and bring it back in. So I want to give it the time to come back in before I make an adjustment, too soon. But there'll be a point where I want to make sure that I'm lessening some of the risk that we have here on the down. The downside of the trade would be 265 if I let it expire out here. So in that case, I may buy back the put side and roll the put side up here maybe to the 225, 226 strike. And what that would tend to do is that would take this expiration line and it would bring it up a little higher, and it would lessen the risk over there, and it would raise my credit a little bit because I would be buying back the short puts for a small amount, and then when I sell the ones, the 225, 226, I would look to get some more credit. And what it's going to do is it's going to bring up the overall risk on the trade. Anyway, let's compare the two. The other thing I wanted to show you is take a look at the slope of this trade if it starts to go against me. How quickly does this trade get under pressure if we have, say, a $3 move in the market? We had, just in the past week, there was a $3 day where the SPY moved $3 in one day. So as I look at the trade, you can see that this one's a much softer slope, where this one is much steeper. And what happens is, if we were to move the time forward, if I just went forward one week on both calendars here and took a look at the two trades a week from now, and we just took a look at those same slopes, you can see that this one did increase slightly to be a little bit steeper, but look at how much of the slope has changed on this one. Look how steep this one is. So what's happening is, the closer you get to expiration, the steeper the slope is, and the more you have to do battle with the market if the price starts to move against you. And what that becomes is that's what's called the gamma risk here. And if you look at this area here, that would be right in here where you can see that this gamma risk, the amount that the price is going to move, when you compare the gamma and the delta, you get an idea of how far your position is going to be under pressure for the next dollar move in the stock if we're talking about the delta, and for the next $2 move if we're talking about the gamma. All right, so let's set our dates back to current day, and let's take a look at a chart for a minute and just see what these break evens would look like on a chart. So what I have here is a daily chart of the spiders, and the pink lines would be my expiration break evens for the December 23rd trade, and then I have a vertical line here which is showing my December 23rd expiration. And then my blue lines, they're showing the break evens for the January 20th trade, and the vertical line here, the blue, is showing my expiration for January 20th. So what you need to do is, as you're looking at this trade, just for putting the trade on, do you feel that over a 2-week period that you have a pretty good chance of the market the price staying within the constraints of the pink line? And if we were talking about the longer duration trade, do you feel that the price will stay, within the light blue lines here? You want to put on a trade where you have a chance to make a profit. So it really wouldn't matter if price went up first, even if it went outside the line and then came back in and then bounced around a little. We're just trying to burn off some time. So on the 2-week trade, what we're looking for is we're just looking to have the market go sideways or perhaps even go up or down first, and then give us a chance where it comes back into our zone where we can take a profit of maybe 50%. So if we look at the market, that it's been screaming to the upside since after the election, November 8th, with really just a 1-week pullback, and then it's launching up again. You might think that an iron condor trade of any kind may not be the trade to put on, but even if after a period of time, even if we move up higher now and continue and get another move, similar to one of these moves, it still could come back down into our zone if we give it enough time to do that. Or maybe you think that this move is going to need to pause a little bit, and maybe we get a few days worth of a pullback and then it starts moving back to the upside. And on the short duration trade here, that'll give us enough time for a week or more to burn off, enough to take our profit. Since one day, this large candle here went from, say, 221.48 up to about 224.60. So we're talking a $3 move in one day. What I want to do is I want to look back at our two trades that we're comparing, and I'm going to change the slices so that we're just seeing current market now. So now we're looking at our current price, and what I'm going to do is I'm going to move our current price up $3 just to show you what one day could do to the trade if it went up $3. So if we're at 226.55 is 226.64 or 65, let's move it up to, let's say, 229.50. So that's about a $3 move, and we'll move the same thing on this one, 229.50. If you're comparing both trades, the trade on this side, we'd be down, the January trade, we'd be down about $44 right now. So if you put this trade on and you're down $44, you're not going to be happy about it, but it's just part of the movement in the price that you're expecting. It's going to go up a little or down a little or whatever, and you're still okay. And if I come over to the short duration trade, while you're still okay, you're under twice as much pressure as you are with the other trade. So you're down about $100. So what if you got another move? What if the next day, maybe it wasn't a $3 move, maybe it was only another $1.50, but is that enough to bring me up to the 231 level? And remember, even if we're expecting it to bounce back and give us a chance to take a profit, will we have enough time for it to bounce back depending on the trade we're taking? And the short duration trade, if we're wrong and the market doesn't start consolidating soon, then this trade will be a loser before we have a chance to have a pullback, where this trade is giving it more time. Even though you're giving it more time to move away from your current price when you put it on, you're also giving it more time for it to come back in. So if I compare the two trades now, the January trade, you're down about $74. And if you come out over here to the other trade, the short duration one, you're down $164. In the monthly trade, if it happened in the first couple days, my personal preference for this in my trading plan is that I would let it go for a while as long as there was still time left. Uh, once the first couple weeks burn off on my say 40 to 45 day trades, I'm okay with it going outside the zone before I do any adjustment. I want to give it a chance to come back in, because once you make an adjustments, then oftentimes it takes longer. You have to be in the trade longer to get your profit. On the short duration trade, you would probably be in a point where you would start to have to act now, where maybe you're going to look at what the benefit would be of buying back the short puts and maybe rolling them forward to try and mitigate what the loss might be. And what that does is, if we do get a pullback after that, then it's going to make it a little bit trickier for you to make your profit on the trade. When you're trying to compare what's best, it really depends on your personality for your trades. What's your plan? Can you comfortably manage the trade or handle that the trade is outside your zone? On a low probability iron condor, it's normal for it to go outside the zone because the expected move is outside the constraints of the iron condor from the start. So, you'd have to expect that you're going to get moves that go outside the zone quite often. You're going to need to have some type of a plan where, if I'm out to the upside, perhaps in the first couple weeks of the trade, if it's the long duration, I'll do nothing. And then once we get inside, let's say 25, 30 days, then I would start to buy back the short side that's not being attacked and maybe roll it up to try and improve my credit and improve my max risk on the trade, and then just see what I can do after that, depending on what price does. Now, on the shorter duration trade, you're not going to have as much time to have the freedom to do all of those moves, and you might not have enough credit in the trade left. Like if this took off to the upside to 231, buying back the short strikes and then trying to sell something up higher, depending on how much time passed, there might not be much credit left to move your line up. All right, so you would have to evaluate it, on an individual basis, depending on how much time is left. Then you'll see, buy back the short strikes, see if I can sell the 226, 225, or what would it look like if I sell the 227, 226, and see what the picture looks like. And here you're in damage control mode once it gets up this far and you're running out of time, where you're just trying to mitigate, your risk here and give it an opportunity that if you get a reversal that you can get out with a profit. In comparison, it's much easier to manage the monthly iron condor because of the slope of the trade. You don't lose the money as fast, and it gives you more time to react. Now, if you're comfortable with what you're doing and you feel that the market has a better chance of going sideways over a next short duration 2 weeks trade, then the shorter duration one could bring in money more often. So what you have to do is experiment. Put on a series of the trades, put on a series of short duration, put on a series of long duration, and find out what you're comfortable with. Manage the trade, decide in your plan how you're going to manage the trade. Are you going to let it run for the first couple weeks? Are you going to roll up the short side on the side that's not under attack and do the same thing, let's say 10 trades, 20 trades, and see which starts to work for you. See which one makes sense to you, because in trading you have to find something that you believe in. So you have to get a system where you've tweaked it to where you're comfortable with how you're going to handle the adjustments if the price goes against you. And after, say, 10 or 20 trades, you'll have a good idea of, is this trade something that I'm comfortable with? Will I be able to do this trade and profit from it? Hopefully this comparison will give you, a little insight into what you might want to start with. If you don't have access to the market and you're working during the day, you might want to not do the weekly one first. You might want to start by doing the monthlies. The only thing is, to do a series of trades on the monthlies, it would take quite a while for you to get the 10 or 20 trades that you would need for your track record. So maybe you do it where every week you're putting on a trade that's, say, 40 days or 45 days out, and you're putting on a new trade and keeping track of it. And this way you can get more repetition of the monthly iterations and see how you would do with that. And the same thing with the weekly. Maybe you just put on every week, you put on another one. But I recommend you sim trade these, because if you sim trade them and get to a point where you're seeing a positive expectancy on your results, then when you put it into play, it'll be something where you'd be much easier to try and scale up and increase your profits over time. Hopefully this will help you choose which expiration is better for you. Thank you and have a great day.